Right, if we change tracks slightly and think about matters from a developer. So a developer, to my mind, would typically be regarded as trading, as opposed to maybe a passive investment business of a landlord. So what are the key considerations here when it comes to reporting and taxation?
Well, just to make the slight distinction between somebody who's developing and purchasing property as investments, the key one that it's not actually the definition, but the key one that HMRC tend to look at is the volume of turnover you're doing in property. That's more like numbers as opposed to the actual amounts. So if you buy and sell one property per year, but do that year on year, you could be potentially regarded as a developer. If you're doing multiple properties in a year, potentially you could be regarded as a developer. That's the one that the revenue tend to look at, because obviously the difference is the reliefs available. So if you're buying and selling and it's an investment, you pay capital gains tax, which could be, depending on whether you're residential or commercial, 10 or 20% for commercial property, 18 and 28% for residential property. But if you're a higher rate taxpayer, developing, you could be paying up to 45% on income tax. So it's always been historically a point. There might be people that like to buy and sell property but don't consider themselves as property developers, but then they can be picked up if they're doing it numerous times. So the property developer, the taxation basically is the income tax rates compared to the capital gains tax rates. And also you'll be doing annual accounts, and you might be developing during the year, but you might not have sold. So you might have sold a previous property. So the one you're developing, you cannot offset the costs against the one you've sold. That would be held in work in progress, and that would be offset against the sale of the later property.
Okay. How does national insurance come into that as well?
As a sole trader? Okay. So if you're developing as a sole trader, which is outside obviously a company, you're liable to income tax on the profits of the property development, and you would also be liable to national insurance on the profits as well. So you'd have your income tax rates and your national insurance rates, which would kick in at 9% going up to 2% over and above your income tax rates, which could be at 20, 40 and 45%.
Yeah, that's a key consideration. I think that some people might not appreciate that it's just an extra level of tax as well. So if you've got development profits being taxed in your personal name, to bear that in mind. Again, that's something a corporate entity can avoid. So CIS, that's a construction industry scheme. What do developers need to be mindful of with this? Because doesn't construction industry scheme just apply to sort of large development companies and projects?
Not necessarily. If you're a developer, then you will be most likely dealing with contractors. So, your typical contractor would be your carpenters, your electricians, your painter and decorators. They could all be contractors. They'll all be most likely in the construction industry scheme. So as a contractor, you will have some extra hoops to jump through. you will have to do a monthly return potentially, where you would have to verify all your contractors to make sure that you're deducting the correct rate, depending on what their status is within the construction industry scheme. So it's just a little bit more compliance is probably the best word for that. And again, obviously, as with most things, if you fail to be compliant, you can be heavily penalised. So you're looking at submitting a monthly return, which you can have £100 penalty for failure to submit on a monthly basis. So that can add up and be quite expensive.
Yes, it's one aspect I think, again, can be a bit nervous about. CIS doesn't apply to investment properties and landlords, but you can slip from one to the other by start developing a property. So just be mindful if you're changing the condition of a property, you're getting subcontractors in. Remember CIS, and potentially talk to one of us, and we can help guide you through what you have to do. VAT can be a monster of a subject, so I want to just keep this one fairly short and sweet. What are the main considerations we might think about in terms of property developer where VAT is concerned?
Well, I think the main thing is you are actually entering a complete minefield with VAT and property development. So you have to be aware of all sorts of different things. So, for example, if you're building a brand new residential home, then you are zero rated, which means you can reclaim your VAT, but you ultimately don't charge your VAT. If you're on a conversion of a home, unfortunately, you do not recover any VAT, but you do not have to, and you're not charging any VAT. If you're converting a derelict building into a dwelling, you'll have a different VAT rate at 5%. And there's many others, and you just literally have to work your way through looking at what you're developing, what aspects you are. I mean, commercial, again, is going to be standard rated, potentially. So you'll be charging VAT at the end. And then in bringing all of that, you then obviously got the whole option to tax scenario that you might be coming through, whereas somebody who's selling you the property, we're looking at commercial now because you can't opt out residential. So somebody might be selling you the property, they've opted to tax, which means they're going to charge you VAT. You don't want to pay the VAT, or you'd like to recover it. That means you opt to tax in order to recover it. And that means you're then opted in, which means on the sale or rental, you have to charge VAT. So it's a very complex area with regard to property, and you just have to really look at what you're purchasing, what you're developing, if you're into development, what you can recover, what rates you should be charging, and take advice along the way, I would recommend.
For those with more involved property businesses, which might comprise a mix of investment activities and development, again, within a company sphere, and there could potentially be benefit from looking at group arrangements to separate trading and non-trading elements.
Yes, and also you might want to separate out VAT exempt transactions from zero-rated transactions, so you don't enter into partial exemption, which I don't want to go into detail here because it's a very complex area. But with VAT, I would say to take a lot of advice up front.